Welcome to Clarity Financial's weekly Underbelly podcast, where we dig deep, discussing financial topics few advisors dare to tackle, and share thought leaders from the world of finance, covering important topics like Social Security, Medicare, retirement planning, and asset protection, providing you with personal finance ideas, not just to save you money, but make you money. Now, the Underbelly podcast,
giving you the edge
and arming you with money truth. And good afternoon. I'm Brent Clampton, executive producer, along with Richard Rosso, our director of financial planning at Clarity Financial. Today we're talking college savings, and our special guest is Mark Kantrowitz, who's the publisher and vice president of research for savingforcollege.com. And Richard Rosso has a slew of questions for you, Mark. We appreciate you being on with us this afternoon.
Thanks, everybody, for coming to being here with Underbelly. And we like to tackle those topics that many advisors do not want to tackle. But this one is near and dear to many's hearts. And Mark Kantrowitz, who's the publisher, vice president of research for one of my personal favorite sites, savingforcollege.com. I used it as a resource. Mark let me know it's been around for about 10 years. It feels longer to me, but that's how long I've been using the site. And I think that, again, for many people haven't been using this resource, hey, we're going to get you acquainted with it and maximize the use of it. So, Mark, thanks so much for being with us.
Thank you for having me.
Yeah. So what I always use Saving for College, because it has been a hub of knowledge for college planning for so many years. And I used to use it to siphon through and try to find the right 529 plans. But can you tell us about, just give us a good overview about the information provided, how the site can assist parents and young adults make smart decisions about saving and planning for college?
Right, so we've been increasing the content about paying for college in addition to saving for college. We discuss all of the various college savings vehicles, from 529 plans to covered education savings accounts and prepaid tuition plans, as well as other options such as ABLE accounts for special needs children. Mm-hmm. We also cover the FAFSA, student loans, scholarships, education tax benefits, and military student aid, and other topics on different ways of paying for college.
And again, you've really have expanded the content over the last, I guess, couple of years or so. I've just noticed how you just keep adding more and more to make the site more robust overall.
Yeah, we have over 1,000 articles on college savings as well as paying for college by now.
So the very basics of this, and you've got some really good college planning tools overall on the site to give people, an idea of what the sticker shock might look like. Any trends? I know it's not a question here, but that's maybe on the big list here. But any trends that you're noticing when it comes to college planning and savings that would be worth sharing with everybody?
Well, college costs go up by about a factor of 3 over any 17-year period. Mm-hmm. And given the 1/3 rule, which is to save about a third of future college costs, that suggests that your college savings goal should be the cost of a college education the year the child was born. For a more personalized estimate, we have the world's simplest college savings calculator, which lets you project future costs, the increases in the net price, and how much you'll have to save versus how much you'll have to borrow, depending on your decisions. We also have a lot of tools on the site, like 529 comparison tools, mm-hmm. Our annual fee study that shows the impact of the different fees and the different state plans on how much money you'll have to pay in total in fees over a 10-year period, and a variety of other tools to make personalized, smart decisions about saving and paying for college.
I think it's great that you break out the fees as well so people can get a handle on what they're paying. I think it's really important.
Yeah, because oftentimes minimizing costs is the key to maximizing net returns.
Mm-hmm. Absolutely. So, a lot starts with the FAFSA, and I talk to parents all the time, and it appears intimidating. Although it's been easier than ever, I think, to complete. Most parents say, you know what? My child's not going to receive any kind of financial aid, or listen, I don't even want to bother. And I say, listen, you need to bother. You're not looking at this correctly. Can you share some of the insights around FAFSA and why it's important to complete, even for parents that say might make more than they think to be eligible, or their children to be eligible for financial aid?
And so the FAFSA, the free application for federal student aid, is an intimidating form. I mean, you have this alphabet soup of acronyms, starting with FAFSA, but EFC and SAR, that really stop some parents from moving forward with the form. But it is your gateway to money from the federal government, from the state governments, and most colleges and universities.
So this is going to open the door, regardless of how much you make. You want to at least open that door using the FAFSA, correct?
Correct. Okay. And you can't get the federal student loans, which are the cheapest loans, without filing the FAFSA. And even if you're wealthy, you can qualify for those loans. And that's a reasonable way for your child to have skin in the game. You're not going to overborrow just on the federal student loans. You'd have to borrow private loans or parent loans to get in over your head. Now,
go ahead.
Right. So the FAFSA is gotten easier this year because they created an app version of the FAFSA. And it takes less time. Yeah, so you can download it to your smartphone, both Apple devices and Android devices. And it makes it almost fun to complete the 100-question form. I said almost, but and the only way to solve that problem is for an act of Congress. But it is much easier than it has been in the past. And it includes and skip logic, so if you don't need to answer a question, it's not going to ask you that question. It's also got what are called edit checks, so that if two answers are inconsistent with each other, it's going to ask you to confirm your answer and point out the discrepancy.
I'm amazed by what you just said regarding that there's an app for a form that's 100 questions, along with tax information and everything. So I need to try this just to figure this out, because you would not think intuitively that the FAFSA would be applicable to an app for a phone. It would be that easy, or becoming that easy.
And what they've done is, some of the questions, it's just one question per screen, and they take advantage of the user interface. So if you're entering numeric information, they pop up a dialing pad to make it very easy to enter this information. They've also added this thing, and they've had it since 2011, called the IRS Data Retrieval Tool. Mm-hmm. And what that does is most people will have filed their federal income tax returns by the time they file the FAFSA, because the FAFSA uses 2-year-old tax returns. In other words, the prior year. So right around April, when you're filing your previous year's tax returns, even if you get an automatic extension of 6 months, that still puts you into October, and the FAFSA starts October 1st.
Got it.
And what this does is it transfers questions from your federal income tax return to the FAFSA, so that you don't have to answer any question that you've already submitted on your federal income tax return. And what's really good about this IRS data retrieval tool is that if the information was transferred from your federal income tax return, it is not subject to verification. They assume that people don't lie to the IRS, more so than they lie to the U.S. Department of Education. And so that's going to save you a lot of time and hassle later, because most of the verification has to do with income and tax information. Very little of it has to do with assets and demographic variables.
Excellent. So if you're just tuning in, you are listening to the Underbelly podcast, and we're with Mark Kantrowitz, who's publisher and vice president of research at savingforcollege.com, an amazing hub of information for you if you're a parent or you're a young adult looking to go ahead and start college. So remember, you can subscribe to this YouTube channel, and you can find our content wherever you find your favorite podcast. So Mark, thanks again. I really appreciate that overall. So it seems that we're making it a lot easier for parents to complete the form, and that's very, very positive because of, and I love the link to the IRS site, so that all this information gets downloaded because it used to be so much more of a process. Not that, again, I've had some people who have tried to fill it out and have had some glitches with the IRS site. Then they had to contact the site and figure something out regarding, how to complete that. Once they did, the FAFSA was able to resume. They were able to go ahead and do this. So I think overall, this door is becoming easier to open. So it's good to hear that there's actually now an app and an easier way to get this done.
Right. And also in general, parents have a tendency to underestimate their eligibility for need-based aid and overestimate their eligibility for merit-based aid. So it's important to file the FAFSA even if you got nothing other than student loans last year, because the number of children in college and other subtle differences from one year to the next can have a big impact on the amount of aid for which you're eligible. Just going from one child in college to two children in college is like dividing the parent income in half. And there's a lot of other subtle details that can make a really big difference in the amount of aid for which you're eligible. So the only way to tell if you're eligible for aid is to apply. I suppose if you are a parent who has only one child, that child's going to an in-state public college as opposed to a higher cost college, and that child, and you are in the top 1% in terms of income, so over $350,000 a year in income, and you have over $1 million of reportable assets, then maybe filing the FAFSA isn't going to get you any financial aid. But for most families, it will get you some financial aid. The wealthier families tend to send their children to more expensive college, and your financial need is the difference between total college costs and your ability to pay. So the increase in the cost of college increases financial need, which increases financial aid. It's not just by reducing the expected family contribution, which is the measure of the family's financial strength. It's also the increase in college costs has an impact on the aid you receive.
So the rule here is, like you said, unless you're really in the top echelon here, and even then, every year you should be looking to complete the form.
Yeah, you can't get money if you don't apply.
That's right. That's right. And again, now that it's getting easier to apply, do not miss out on completing the FAFSA. So, of course, the 529 is popular. Most people know what it is, but we have a lot of people that we meet with and who listen to the podcast that have no idea what a 529 is. So what should parents, grandparents understand about them? And can you share the benefits of a 529 plan over a state prepaid plan or vice versa?
Right. So only about 18% of children under age 18 have 529 plans. And only about less than a third of parents are aware of 529 plans. Because unlike a 401k, where every time you change jobs, the HR director tells you about a 401k, they don't even tell you about 529 plans when you're giving birth to your child in the hospital. So there's a lot lower awareness of 529 plans. In a nutshell, a 529 plan is one of the best ways of saving for college. It's got tax advantages and financial aid advantages. It's like a Roth IRA in that you contribute after-tax dollars, but unlike a Roth IRA, like a Roth IRA, it's after-tax dollars. They accumulate earnings on a tax-deferred basis, and the distributions are entirely tax-free if you use them to pay for qualified higher education expenses. Unlike a Roth IRA, you can, in about 2/3 of the states, 34 states and the District of Columbia, you can get a state income tax deduction on your contributions to the 529 plan. That's better than a Roth IRA. And from a financial aid perspective, if the account is owned by the student or that student's parent, it is reported as a parent asset on the FAFSA, which is a favorable financial aid treatment. It means that for every $10,000 you've saved in that 529 plan, at most $564 reduces your aid eligibility, which still leaves you with $9,436 of additional money to pay for college, or more importantly, to reduce your student loan debt. That contrasts with money in an UDMA or UTMA account, which reduces aid eligibility by 20%. So $10,000 in a custodial bank or brokerage account will reduce aid eligibility by $2,000. Or if the grandparents give money directly to the college, that's going to reduce aid eligibility by $5,000, half of the distribution amount. So clearly, you're better off having the money from a financial aid perspective in the parent-owned 529 plan or student-owned custodial 529 plan account. It's just so much better.
So much better. Yeah.
And oftentimes, grandparents want to leave a legacy for the grandchild, and they make the mistake of saving the money in the grandparent-owned 529 plan. There are a variety of workarounds. You could change the account owner to a parent. You could roll over a year's worth of funds at a time from the grandparent-owned 529 plan to a parent-owned 529 plan, but it has to be in the same state to avoid recapture provisions. Or you could just wait until after January 1st of the sophomore year in college to take that distribution. Because remember, the FAFSA is on a prior year basis. It's using your income and taxes from 2 years ago, which means that once you hit January 1st of the sophomore year, if you're going to graduate in 4 years, there's no subsequent FAFSA to be affected by that distribution from a grandparent-owned 529 plan.
Excellent point. So there are Coverdell's, and of course they're not as, and I always love them because you were able to tap that money for education before college. And then, of course, in the provisions in the Tax Cuts and Jobs Act, now there is some flexibility with a 529, correct, to tap some of those dollars for private school and so forth before college. Am I correct?
Yes, you're correct. The Coverdell Education Savings Account, one of its attractions was the ability to use the money to pay for K-12 expenses. The Tax Cuts and Jobs Act added a similar capability to 529 plans. You can use up to $10,000 a year to pay for K-12 tuition. Since public schools generally don't charge tuition, that basically means private schools and religious schools, you can use it to pay for their tuition. I'm a little bit cautious, though, about encouraging families to use 529 plans or Coverdell's to pay for K-12 expenses, because one of the strengths of a college savings plan is and one of your greatest assets is time. The more the money is in the plan, the more time it has to compound and to grow. So if you're taking money out after just a few years, there will be very little earnings. It'll almost entirely be savings. And the real benefit of these plans is the tax-free earnings.
I agree with that. And that's why I sort of liked the Coverdell, and I was hoping maybe we'd add more muscle to it so that you can plan and then prioritize as a planner when you work with a couple that are looking to save for college, but also would like to have some resources or good savers that can use the Coverdell. But I agree with you. It sort of muddies the water a little bit to have the provision, but I guess that was the decision. So people need to be aware of that. If this is for college planning, that's what it really should be utilized for. The benefit to me as well, and we've been trying to help grandparents understand, is that once you set up a custodial or a UGMA, UTMA account, that's pretty much an irrevocable gift to the child. Once they reach the age of majority, they can take this money and do whatever they want. At least the 529, you can retrace. You can sort of retract that. Say if one of your grandchildren doesn't want to go to college, and you can leave it to another. So there is some flexibility that the 529 has, which I always liked.
Yeah, you retain control over the account, even though it's treated as though it's an immediate gift.
Absolutely.
So it's got these great estate planning provisions like 5-year gift tax averaging, where you can do a lump sum contribution up to 5 times the annual gift tax exclusion, and it's treated as occurring over a 5-year period.
This is our Underbelly podcast, and we're with Mark Kantrowitz. And Mark is a publisher, vice president of research for one of the best hubs for college planning and saving information, savingforcollege.com. And of course, you can go to realinvestmentadvice.com. Lance's reports will be out tomorrow. That's our hub of information for everything about finance, especially in volatile markets. So, Mark, thanks again for being with us here today, talking about these benefits of a 529. Obviously, the 529 is a provision, and the state prepaid plans were an offshoot of this, right? That was the more popular leg of saving for college years ago, was the state prepaid plans. Have those changed quite a bit? I know that you can possibly roll money over from a state prepaid plan into a 529. What are the pros and cons, say, of a state prepaid plan? Because I do have a lot of people that say, I really love this idea, especially in Texas. Everybody loves Texas schools, that I can just take care of this, and then I know that my children are going to go to a Texas school. I'm going to insist on this, and this money is available. But I usually take the 529 option over that. But give me some of your insight on compared to the state plans, the prepaid plans.
Right. Well, prepaid tuition plans and college savings plans are both technically 529 plans. Mm-hmm. So 529 plans usually refers to the college savings plans. The first college savings vehicle of this type was the Michigan Education Trust back in 1986. And it wasn't until 1996 that Section 529 was added to the Internal Revenue Code to define a 529 plan. The difference between a prepaid tuition plan and a 529 plan is like the difference between a pension plan, a defined benefit plan, and a defined contribution plan like a 401k or a Roth IRA.
I love that description. Yes, absolutely.
So the difference, in theory, if you buy a year's tuition through a prepaid tuition plan, it's always going to be worth a year's tuition. The problem occurred that most of the prepaid tuition plans were underwater. They were projected to have financial shortfalls where they might not be able to keep that promise. Some of them were guaranteed by the full faith and credit of their state, but it wasn't entirely clear what that really meant. Mm-hmm. And there were also restrictions that you only could use the money in many states for a public college education in that state. And so the 529 plans, where you have all the risk, but you also have all the control, became a lot more popular because you would end up with keeping all that return on investment. Whereas with a prepaid tuition plan, first of all, you weren't buying a year's tuition. You were buying a year's tuition plus a premium. So you were actually paying more than a year's tuition to invest. And there was no really good guarantee that the prepaid tuition plan would make good on its promise. In fact, in Texas, they had to close one of the plans because they had actuarial shortfalls, and then they opened a new plan.
The new one, yes.
Right. So it provides you with some reassurance that you're going to have it paid for, but that promise they might renege on that promise. Mm-hmm. So it's not as comforting as it might seem. So these days, I just recommend that families use the 529 college savings plans, and that within those plans, you can control for the risk. During any 17-year period, there is going to be at least 3 corrections. That's a drop of 10% or more, and at least 1 bull market, a drop of 20% or more in the stock market. And you can control for this by using an age-based asset allocation, which starts off with aggressive mix of stocks versus bonds. And as college approaches, you shift it away from stocks to a safer mix of investments. That way, when the child's young and you don't have as much money invested, the stock market drops, you've got 17 years to recover from your losses. But when college is just around the corner, most of the money is going to be in a safer mix of investments.
Excellent.
And the prepaid tuition plans have generally worked very well when the stock market is booming, but when the stock market isn't performing as well, they tend to have pressure from 2 directions. First is they're not earning enough money to cover the cost of the tuition, and the tuition rates tend to go up at double-digit rates during an economic downturn. So, and that's why there have been problems with these prepaid tuition plans, and some of them have started investing in really risky investments like hedge funds to try to make up for that, and they've been burned as a result.
Got it. So say, for example, I've overfunded this 529, and I've seen that because, like you said, grandparents using this, you can fund quite a bit of money in these plans. some cases over a couple of $100,000, correct?
Right, 235,000 to 520,000 is the maximum contribution, depending on which state you're in. I think New York is at 520,000. I don't recall Texas offhand.
So if there's money left in these plans, first of all, I can change beneficiaries. So, hey, even if a parent wants to go back to school, they can change this. Am I off, or am I right about that?
You can change the beneficiary to a relative of the current beneficiary. So it could be to a sibling, to a parent, an aunt or an uncle. You can also use the money to pay for grad school.
Yeah, that's
and
right.
Worst case scenario, there's no age limit. There's no time limit on how long you can keep the money in these plans, unlike the Coverdell Education Savings Account. So you could just keep the money in this account, and maybe your child doesn't go to college, but their children go to college.
That's right.
You just left a legacy for your grandchildren or great-grandchildren.
Excellent. Great point. So how can parents help students prepare to win college scholarships? Because that's another area as well that people say, you know what, make too much money. There's no way my kid's going to get a scholarship. And of course, this is incorrect. So maybe you want to share in the last part of this podcast some insight into why this is also important. And I know you have a lot of good information on savingforcollege.com articles about this topic.
Right. So about 1 in 8 undergraduate students in a bachelor degree program is using private scholarships to help pay for their college costs. The average amount is about $4,200 a year that they're using. So it's part of the plan for paying for college, but it's not the entire plan. It's very rare for students to win a completely free ride. Less than 0.2% have scholarships exceeding $25,000 a year. So it should be part of your strategy, and it certainly is a good strategy because you should always pay with free money first.
That's right.
And that's every dollar you win in a scholarship is a dollar less you're going to have to borrow. But you should enter into this with your eyes wide open. Now, you can increase your chances of winning a scholarship by there's these online scholarship matching services. And we have an article that links to 15 of the free ones.
Okay.
Never pay money to get money. If you have to pay money to get money, it's probably a scam.
That's right.
But use the free online scholarship matching services to do a targeted match of your background with the selection criteria for the scholarships. The typical high school senior is going to match anywhere from 50 to 100 of these scholarships, and then apply to every single scholarship for which you're eligible. You can increase the number of scholarships that you match by answering the optional questions, not just the required questions, in these scholarship matching services. Because a lot of those optional questions are there to trigger the inclusion of specific awards. Like there's usually a question about whether you or someone in your family was affected by cancer. And that's because there are 24 scholarships for children who have themselves had cancer, or their parents have had cancer, or a sibling has had cancer. And so they're not going to match you against those scholarships unless you answer that question. Now, it might not be that question, it might be a different question, but there usually are a bunch of questions that will trigger additional scholarships matching your background. And on average, students who answer the optional questions will match about twice as many scholarships as students who answer just the required questions.
We've got Mark Kantrowitz from savingforcollege.com with some incredible information here about scholarships. So remember, you can subscribe to The Underbelly and our other podcasts and our YouTube channel, and you can also find our content wherever you find your favorite podcasts, iTunes, Stitcher, wherever you find your podcast, you're going to find Underbelly. So, Mark, this is important. So on the site, because I saw this, you have a scholarship link, and you're able to go through this matching process and answer these questions to see what's possibly available, which is indispensable.
Yeah, absolutely. And we also have lists of articles like scholarships that are over $25,000 because some families just want to go for the gold. But it's usually the smaller scholarships that are easier to win apply for a $500 scholarship. They don't think it's worth their time. But suppose that it's you have a 1 in 10 chance of winning the scholarship, and you apply to 10 such scholarships, odds are you're going to win one. And it takes less than an hour to enter any one of these contests. So odds are that you're going to spend 10 hours to earn $500. That's $50 an hour. I don't know of any kid who can earn $50 an hour for doing something legal.
It's like the lottery. Nobody plays until it's like a $10 billion, and then everybody wants to play. Listen, the money is there. And so, Mark, this has been just incredible information. So savingforcollege.com, you seem like you're adding more and more information to the site every day. So it's becoming a really, I mean, it was always comprehensive to me. I love how you rate the 529 plans, and that's how I used to help people find the right 529 plans. I think you have, because I looked the other day, just a list of some of your favorite or the highly rated 529 plans that are out there. So Saving for College is really, to me, one of the first places you should go to really get a handle on things. So I suggest it to everybody. So Mark, hope you're on again, but thanks so much for the incredible information for the podcast today.
Thank you.
Well, that was really exciting. And again, I think Mark's busted some of the myths about, hey, I can't get financial aid. I can't get scholarships. Yeah, you can. And Saving for College is a great hub along with your financial partner. So thanks again for listening to us here at Underbelly, and we will be back.
Well, thank you, Richard. Thank you, Mark.
Yes.
The Underbelly Podcast is a production of Clarity Financial and Real Investment Advice. For past episodes, blog posts, and additional information, go to our webpage, realinvestmentadvice.com. From all of us at Real Investment Advice, thanks for watching. Have a good weekend.